If you're an NRI, how much money can you actually send back to India? Is there a hard legal ceiling on what you can move? Under the Foreign Exchange Management Act, or FEMA, the limit does not exist. You can legally remit 10 lakh, a crore, or your entire life savings into India without a cap. Yet transfers are frequently paused, frozen, or flagged for questioning by banks despite this legal freedom. Moving unlimited capital across borders creates a specific trade-off. You gain total mobility of funds, but you also assume the burden of absolute financial transparency. Your ability to move money freely depends on navigating strict compliance checks without triggering an internal bank audit. To understand why some transfers sail through while others are blocked, we have to look at how banking systems calculate risk based on the volume and frequency of your transfers. This chart plots transfer amount against the complexity of paperwork required. As amounts move up the y-axis, compliance requirements intensify. Smaller transfers sit in the bottom left, clearing the system almost instantly. Large lump sum transfers behave differently. They move into the anti-money laundering scrutiny zone, which triggers an automatic pause in the transaction. In this zone, banks require clear evidence of the source of funds and mandatory PAN linkage before the transfer can be completed. Successfully moving large amounts of capital requires trading financial privacy for a proactive, documented paper trail. Beyond the banking hurdle, you have to consider if the Indian government views the transfer as taxable income. This decision tree shows that your tax liability is determined by two factors: who receives the money and where that money originated. Transfers to your own Indian accounts or gifts to close relatives, like parents, a spouse, or children, do not incur income tax. Tax liability changes once you send funds to friends, distant relatives, or non-relatives. Any amount over 50,000 rupees sent to a non-relative is legally treated as taxable Indian income rather than a tax-free gift. There is one constant exception. Business revenue or rental income earned abroad but received directly in India is always taxable, regardless of the recipient. The exact same 20 lakh transfer can result in a 0% tax rate or a significant tax penalty based on how you structure the recipient's identity. Knowing the tax rules is the first step. The second is choosing the physical method to move the capital. This matrix evaluates the two primary options: traditional bank wires and Forex transfer apps. We're comparing them on security, cost efficiency, and exchange rates. Bank wires offer the highest level of institutional security, but they typically involve high flat fees and exchange rates that are less favorable to the sender. Forex transfer apps provide much better cost efficiency and mid-market exchange rates, though they may not integrate as seamlessly with complex banking compliance for large amounts. For pure NRI savings, routing the money through a non-resident external, or NRE account, provides the most reliable route for keeping funds documented and repatriable. Always check the Forex markup, the difference between the market rate and what you're being offered, to avoid paying an unnecessary premium. Choosing a transfer method is a direct choice between the premium security of traditional banking and the higher margins of digital apps. Even with the right method, certain transfer patterns will trigger a bank's compliance algorithms. Sudden, massive transfers from a new source or a transfer size that doesn't align with your declared income will cause an immediate flag. Omitting a proper purpose code is a common mistake that leaves funds stuck in a verification queue for weeks. Banks also monitor for frequent round transfers, money that moves back and forth across borders, as this behavior mimics money laundering patterns. Automated systems do not evaluate your intent. They only check for the presence of the required validating paperwork. To apply these rules, let's look at 3 specific strategy profiles for NRIs. Here are 3 profiles: routine supporter, high net worth investor, and gifter. The supporter uses Forex apps for frequent family transfers, capturing best rates tax-free. The investor moving real estate capital must route exclusively via direct bank wires into an NRE account. Paying higher bank fees ensures a clean audit trail, making it much easier to move that money back out of India later. The gifter sending money to friends or distant relatives faces a strict 50,000 rupee limit before tax liabilities are triggered. If you plan to exceed that amount, the recipient must be prepared to file that transfer as part of their Indian income tax return. Efficiency comes from matching your transfer method to your specific financial motive. NRIs can move wealth without fearing non-existent FEMA limits, provided they respect the structural tax boundaries that actually exist. Use NRE accounts for significant savings, keep meticulous documentation of sources, and correctly classify the recipient. Transparency and proper categorization ensure your capital moves across borders without restriction.